Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Tim Braun and Kevin Hockert from the Minnesota Chapter of the MTA, and with us today it is our great pleasure to have Tim Hayes, CMT, and Chief Global Strategist with Ned Davis Research Group with us today. For those of you who may not be familiar with Tim, he has been with the firm since 1986. He directs Ned Davis Research Group's global asset allocation services, develops strategy and major investment themes, and establishes Ned Davis Research Group's weightings for its global asset allocation, presenting his views on the cyclical and secular outlook for the globe. Tim oversees Ned Davis Research Group's monthly investment strategy covering global strategy and allocation. His timely market commentaries and studies have been featured in global strategy publications, which focus on global allocation and the most significant global developments. And I also have with me Kevin Hockert. And Kevin, I'm going to turn this over to you, and perhaps you want to start out with a couple questions for Tim.
Sure, I'd love to. Thank you. Thanks, Tim. I would like to thank you also, Tim, for the presentation that you gave. I thought it was phenomenal. I think it appears to be a very complete package of research that you guys provide, maybe somewhat traditional research in terms of breadth and trend and momentum, but certainly the economic data series that you incorporate and your composite sentiment series seems to be a real complete package, and thanks again for the presentation. I think it was great.
Oh, thank you.
You bet. You mentioned on recently while on the road, one of the common questions that you seem to receive from a lot of your constituents is, where are we at today as compared to 2008, 2008 that is, and you shared, rates are lower, inflation's lower, we've had our policy response. There's a few other things, that we're looking at today from an economy standpoint and a market standpoint. Do you care to compare and contrast today relative to 2008 from any of those data points?
Sure. I mean, I think it is. We're in that post-2008, post-crisis environment where the markets really have been obsessed about the potential for sliding back into that kind of crisis atmosphere, and that's what's really keeping this basing phase or this rebuilding confidence phase going in terms of the markets, which is reflective also of the economic environment we're in. But I think there's really 7 major differences that we found. In fact, we went back to sort of determine if the similar environment we had over the summer, which if you remember 2008 was the Beijing Olympics, this year of course was the London Olympics, and in 2008 we had an election. Of course, this year we have an election, and the markets drifted over the summer. Pretty much the attention had been taken away from the Bear Stearns debacle in the spring, and similarly here we had the second quarter correction of the market. Worries about Europe were widespread at that time. So the concern was that we'd come back into the fall and we'd sort of get back in that 2008 environment where things would get a lot worse before they get better. Well, I think what we found is that the differences are not only in the economic momentum. If we look at leading indicators that are looking a lot better, in fact, the housing data and some other economic data confirm what the market's already been telling us since June, was that we're in a much in sort of this recovery phase in the market. Also, the sentiment was a lot worse in the early part of 2008 and got a lot worse in the fall. Things got a lot worse before they got better. Now we're seeing the sentiment actually having bottomed around the June low, and now we're sort of in that favorable zone where we've had that peak of pessimism, but optimism is starting to drive the market higher, or at least a pickup in optimism, not excessive optimism. It's a kind of optimism, return of optimism that's consistent with the improvement in the tape indicators that we've been seeing, and that is another key point as well, is that we're seeing much broader participation. 80% of the stocks around the world in 45 major markets have, it's actually 86% of 45 markets have rising 200-day moving averages. And in 2008, that percentage was actually stalled at 30% in the first half of 2008, stabilized over the summer, and then got a lot worse and dropped as far as zero by the time the crisis was over. So, and there's some other things I won't go into a lot of detail, but having to do with the volatility and spreads of the market, the monetary conditions were much tighter back then, whereas now we've had this major global policy response. So also the earnings environment, we're going into a major earnings recession, we're going into a major economic recession, and as I mentioned, the election was shaping up a lot differently than this one. So there was just really a number of major differences, and I think what it tells us is that we're coming out of, we're still in the sort of recovery process that can keep the market sort of climbing this wall of worry, which I think is going to be supportive through the rest of the year.
Thank you, Tim. Appreciate that. So another question, you referred to the international markets. There have been some policy responses abroad, from a relative strength or relative performance standpoint. Many of the international markets have lagged U.S. Seems like some of them are turning. You mentioned this data point, percentage of stocks above the 200-day, percentage of stocks with a rising 200-day. Care to comment on that, and what are you seeing or hearing out there? I mean, are you seeing some reallocation, if you will, or new allocation to international versus U.S. at this point, or where would you say we're at there?
Well, as I mentioned, the fact that the vast majority of the markets do have rising moving averages is a sign that this market has broadened out. In fact, this is a very highly correlated environment. So the fact that we have the markets moving together is something we need to watch, and is a good sign that this trend can persist longer. One of the areas we're focused on is, as other markets have kind of got on board here, the U.S. is really the outperformer for the last 2 years. And now we're starting to see the U.S. become more of a market performer as other markets are doing better. Europe has come out of its crisis phase and actually had a nice mean reverting run in the initial liftoff from June. Also, emerging markets now are starting to regain momentum, and I think an area really to watch closely is China, which has started to regain some momentum ahead of the changing government, perhaps anticipating a stimulus move after the new government takes over. So I would be keeping an eye on emerging markets, and as this trend, and if it does continue to broaden out, that would have implications for the areas that have thus far been lagging, and they may actually be outperformers of the U.S. Going forward.
Excellent. Thanks again. One more question, Tim. I think we would be remiss if we didn't talk about the election. Obviously, it's right around the corner. You guys have done a ton of work in terms of election cycles. Care to just reconcile a little bit in terms of what you're seeing in past cycles and perhaps what appears to be taking place today?
What tends to happen in the election year is the market tends to, and actually what we've seen some consistency with this, the market tends to rally in the first into a high around April, and then the market tends to sell off into June, and then you get a rally into the election. And that's pretty much what the market's done this year. But what we find is if we subdivide that election year tendency into years when the incumbent has won versus years when the incumbent has lost, there's a pretty big contrast. When the incumbent has lost the election, the April high is actually lower than where the market started the year on average. The market does come back over the summer, but the big divergence occurs right around early September. If the incumbent's going to lose the election, the market actually tends to sell off and even make lower lows, and clearly that was the case in 2008, and we've seen it in many other cases when the incumbent has lost. When the incumbent wins, the market does much better than normal. In fact, the market tends to be at highs for the year and continues rising into the election has a bit of a sell-off, and then closes the year at new highs. So right now, the way the market's performing, it had been looking pretty consistent with the incumbent winning. Just more recently, that we've had this sort of choppy phase of the market. It seems like the market's almost telling us it doesn't really know what the outcome's going to be, which is sort of consistent with what this tightening in the polls we've been seeing. So that might be something to keep in mind, is that we watch the election, see what the outcome's going to be. And really what it comes down to is our investors that lacking in confidence, or voters that lacking in confidence that they're willing to take a bet on somebody new. That's usually not good for them. That's usually a sign things aren't good for the economy, and the market tends to reflect that by selling off. So yeah, I think there is we're at an interesting point right here in terms of the market and as it relates to the election.
Sure. Thank you. Thanks for tying that together.
Tim, a couple of things. One is, generally speaking, your longer-term outlook is very positive. Is there one thing in that litany that would what in that litany would change your mind or change your view on your current outlook?
I think the longer-term view is that we've been in a secular bear market since 2000, but we could be in the very late stages of that secular bear market. And really, this rests upon the market beginning to anticipate better annualized economic growth going forward, which would be the result of this massive global accommodation having the intended effect eventually of returning conditions back to some kind of normality in terms of economic growth, and then the market could have more normal growth, break out to record highs, and continue going up. So really it rests on the fact that the market's going to tell us before we see it in the economic numbers. But if in fact we're going to remain in this sort of stalled out environment, or this frozen environment, we're not going to see the normal turnover of money and the normal response to the accommodation. And we're not going to, some of the economic momentum we started to see stalls out. And if in fact we're just going to remain in more of a Japan-style environment, then the market's going to pick that up, and we'll see not just another shallow decline, but maybe something a lot worse on the next decline in the market. So it really, I think, relates to, again, remembering that the stock market is the best leading indicator of the economy, and if in fact the market doesn't keep going, it's telling us that this massive global accommodation is not having the intended effect. In fact, each quantitative easing move, both in the U.S. and globally, has been met by diminishing returns thus far. In other words, each rally after the QE has been less and less, which tells us we really have to have the economy kind of carry the ball forward here. And if the market doesn't see that happening, we could see a pretty stiff sell-off in front of us.
Very good. Tim, for the people on the other end of the microphone here, if one wanted to find out a little bit more information about you and some of the research that you do, what's the best way of contacting you and/or Ned Davis Research Group?
The best approach would be to go to our website, which is ndr.com, and you'll see there our homepage and have all the contact information will be there, and you'll also get an overview of our firm and what's available from our service.
Very good. And I would like to thank our good friend Kevin Peskin for having coordinated this event for us today. And from Tim Braun and Kevin Hockert and the rest of the people here at the Minnesota chapter of the MTA, we're wishing you all an uptrend. Thank you very much. Have a good night.